And I was swinging like I was trying to crush a home run.
Did you play the bat? Did you do the bat spin thing first
No.
before? Yeah.
But then we had a rule where you had to hit with your like the adults. If you're right-handed, you had to hit left-handed.
Yeah.
Because we had little kids playing, so we
Right.
didn't just want people crushing it. And
Yeah.
I was two for 4 with 2 strikeouts. How do you strike out? And it's not like there was a good wiffle ball pitcher,
Right.
It wasn't like the wiffle ball you see on TV where it's freaking moving.
Right.
It's just couldn't hit the ball. Couldn't put the bat on it.
Couldn't put the bat on it.
So that was awesome. My neighbors, even the neighbor and his buddy came over and just like posted up on lawn chairs, and we're watching our wiffle ball game.
That's better than watching
Dude,
ESPN late at night, right?
Yeah, they each had a big like Yeti cup, and
Yeah.
they're just sitting there watching, which was probably pretty fun.
Oh yeah, absolutely.
But I think they had company or something, so
Oh,
the wife
yeah.
was probably like, "Get back over here to our party."
Yeah, trying to avoid the relatives, right?
Yeah. So it was good. It was awesome. What'd you do?
Well, we had the neighbors over for the 4th. My brother has golf on Ellis, or a house on Ellis golf course, so we watched the Ellis fireworks on the
Oh,
3rd.
yeah. We could see just because by the time you get out to our house, you're so high up in elevation, and then there's hills in between. We can see like just the top of the big,
gotcha, yeah.
and there's enough tree cover.
Yeah.
But we could see the top of the fireworks down at Elias.
They have a finished, like, cemented back deck with decorative lights, and I was saying, Jay, can you, like, move that decorative light? I can't see the whole firework because it was like, Jay, get up, and there's, like, one limb in my way, but otherwise it was right.
There's just something about having a sweet buzz on and watching fireworks.
Yeah.
It's just awesome.
It is. It's really cool.
All right, well, ready? Listeners, welcome back to the Behind the Wealth Show. We have a special guest today. Roger, who usually hosts the show, is traveling for business this week, so we brought in Jonas Everett. Thanks for being on the show.
You're welcome.
And Jonas, you've been on several times over the years, so you're kind of like the third stringer on the Behind the Wealth show.
When you run out of pitchers, you call me from the dugout.
We point over there and do a wave, and then you come running in.
We have a good chemistry on the radio together. We're always seems to be that we're always on the radio together, and
yeah, but it's good that we always have people that we can fill in. And so anyway, Jonas, how's your summer been going?
Oh, it's been going great. Yeah, a lot of fun family time. A lot of always new financial stuff, and we're in a political year. So how great is that for a financial person? You have something to talk to with your clients about. Sometimes the phone conversations end up being over an hour, but that's okay. People want to talk about the election coming up and their personal finances.
Yeah, which unfortunately for us, in an election year, we start getting these questions. I was probably getting election questions at the end of 2023, so it just happens. Right. But now we just had the first debate recently, so I'm sure it's just going to get more and more ramped up. I think we're fortunate here at Premier that we do a good job of coaching our clients through that stuff. So they've heard us say 18,000 times that the market's most likely not going to care who wins the election. So they're getting, used to that idea. But yeah, we're only going to talk about it more until it finally happens.
That's right. That's right. It's building up to the big boom in November.
Yep. So you want to dive into your first topic here? It looks like you got about 7 things you should never do.
Yeah, there was an article recently, and I think it was a MSN Money article about the 7 things you should never do in retirement. And I love a never do list, Elias. That's how I follow instructions really well. I'll give you an example. I have a pool guy that helps me set up my pool each year, and he starts with a never do list because he takes one look at me and he's like, "This
I need to teach him what not to
this
do."
guy might end up doing something wrong." So he's like, "Never
That's
put
great.
chlorine." And I had a new pool, a different kind of brand of pool. So he's like, "Never put chlorine in the filter." And there's a sticker there just for you that says never. And he had the X, he had the hands with the chlorine tablet. So never do that. And he's never adjust the pump. When the pump is running, you're going to blow the pipes out, and I'm going to have to come back and help you fix all of this stuff. So very, very simple lesson on never do these things in retirement. I really like this article. I think the first one, never retire too early. If you like your job and you're in good health and there's really no reason to retire, and there's a local grocery store here in town where a lot of guys and gals started working at the grocery store at 12 and 14 and 16, and they ended up retiring at 52 and moving down to Florida. Well, it ended up that they retired too early because what ended up happening was they lived down in Florida for a couple of years and then they came back and now they're working back at the grocery store. So you don't want to retire too early if you don't need to.
So is that kind of so for them, is that group, are people back to work?
They're back to work, and it's not for financial reasons. That's
something to do.
Yeah, just something to do. They went out of their social network, so to speak, and they went down to somewhere, and they knew the other retired people down there, but it wasn't a part of their lifestyle in retirement. And in your 50s, it just ended up being too early for them. And plus, there's a lot of pressure with life expectancy, as you know, Elias. If you retire too early, then you're going to need that much more money to retire and live on in retirement.
True. Well, hopefully, I guess in that situation where they took a couple years off, that's kind of probably a good practice retirement. Right. Because I'm sure during that time they really figured out and got dialed in. When I'm ready to just make this permanent retirement, I know what I want to do with my time.
Right.
So there's probably benefits to that.
Well, that's neat. What are you going to do with your time? Are you going to go to refereeing the full time or just because I think that's one of the most important things that you can do. Think about what your life is after work and really kind of visualize that, because my most successful customers in retirement, not necessarily financially, they have it pegged. So a lot of them are like, we're going to help out on the farm and move rocks around, and everybody has a unique situation. What's yours after you're done working?
Well, fortunately, in this career, you can work a long time, and
Right.
we've built a firm where here you can kind of enter into part-time retirement, so you can keep working with a lot of clients, but maybe have less of a workload. But if I was going to be fully not working, it would be a lot of pickleball, golf, officiating football. I may start coaching a different sport outside of football.
Right.
So I would fill my time with activities like that. I would probably do more philanthropy too.
Right.
I'm fairly handy as far as like easy electrical and plumbing work, and then carpentry for sure. So, maybe work with an organization to help build houses or do something. I would fill my time. I'm kind of a busybody, so I'm never just going to sit around and do nothing.
Right.
But those are the things I would enjoy doing.
Well,
doing them for not getting a paycheck, right? You got to do stuff that you like to. One, it's either going to cost money because it's a hobby,
right?
Or you're going to volunteer and not get paid. So hopefully you enjoy it and it's fun.
Yeah, that's neat that you've actually thought about it at your age. The next one on never do list, and again, a never do list is really, it resonates with me. I have a skin doctor that I'll go in and he'll take little spots off my face once a year. And I got so sick of it so many years in a row, I asked him, what do I have to do? Never go in the sun? And he's like, no, never get burned. So that really resonated with me that, I just have to watch it fair skinned. The second thing I think that people should never do in retirement, this article's said, and this makes the most sense financially, is overspend. And we've had situations here at the office where people, they sounded, we got to know them, they sounded like that they were financially responsible, and then they retired, and all of a sudden it's kind of like a downward spiral, Elias, getting into the cookie jar. You get one cookie out, you take one lump sum, and then all of a sudden that wasn't too hard. That's kind of nice. Let me get $25,000 out of my retirement account for a retaining wall. Let me do another $30,000 for a car, and we're trying to walk these people through how they should never use their retirement as a piggy bank. But it's almost a downward spiral, and we had one situation where really the entire life savings is practically depleted, and there wasn't anything we could do about it. We had good advice, but the actions of the customer was a different situation. So don't use your retirement as a piggy bank.
And it's sad when you see that happen, but it does. It happens. People will overspend, and it's kind of like when you mentioned a downward spiral, the overspenders who are doing it at such a rate that, and we're talking people will spend $1 million or to $2 million retirement accounts over 2, 3, 4 years. I mean, they are spending more money than they ever did while they were working. And part of it is while they were working, they didn't want to take money out of this account, and then it became basically a huge piggy bank that you just start robbing from, and it's your money, right? If you call and ask for money, we have to send it.
Absolutely,
we might ask some questions and say, hey, Mr. and Mrs. Client, this spending rate's not sustainable, but it's your money. We can't tell you no when you call and ask for it.
Yeah.
But yeah, that's a huge one. I think you should. I do think you should spend your money and enjoy it in retirement, but the risk of overspending is there for everyone, so you always got to keep that in control.
Yeah, it usually doesn't happen, but that's definitely something you should never do in retirement. The next one on the list, what you should never do, don't take your Social Security early at a penalty, at a reduced paycheck, if you don't have to, and more importantly, if you haven't done a plan, and the plan involves really doing a family tree and figuring out what your life expectancy and your unique situation is. But Elias, you have 46% of Americans are just itching. They just can't wait to turn 62 and take it early, and they take the penalty.
They do, and it's that's probably the hardest recommendation, in my opinion, to walk a client through. Because if someone, and you've been in those meetings or been in conversations where they're dead set on taking it early, and it doesn't matter where they got that advice or how they came with that idea. But once people are set on it, and then the other thing is once you do it, you don't get a redo on Social Security. Once you file and you start taking it, you're pretty much done at that point.
Yeah. So, but planning, that's really all about seeing if the numbers math out. The next one, I know you love this, is we talked about this on the radio show. Underestimating inflation, and then having young families like you and I do. I have teenagers, 16 and 18. If more than two people eat at the sandwich shop, you're running into a $40 or a $50 carry-out bill if we all decide to get a sandwich. So in my frugal mind, I'm like, well, I have bologna in the fridge, so I can buy 2 sandwiches, and that's still $24 with barbecue chips. But I've defrayed a little bit of this cost. But Elias, what have you seen that has just jumped up and really put a squeeze on your pocketbook with a young family?
So I think, one, food in general. Food in general has become very expensive, especially the going out to eat. I mean, just go to your local sandwich shop and to walk out of there with a drink, a little bag of potato chips, and a sandwich, just for one person, you're going to be $10 to $15.
Right.
So then if you try to feed 5 like we have in our family, it can get expensive. And I like the other thing you said about don't underestimate inflation. That's one of the biggest things I'm talking with people about right now. I do think we should feel good about the positive economic data that's come out suggesting, right, we're getting the inflation issue resolved. But just because we have a few good reports on economic inflation data, it doesn't mean we're out of the woods. So I think people should set their expectations on inflation to be persistent and could even possibly start going back up.
Yeah, and
right?
You look at retirement. You and I, we're not retired, so we have earning years left. If you're retired on a fixed income, you're not taking inflation into consideration. That's going to sneak up on you eventually. And kind of like you said, it doesn't really matter what the inflation rate is; it's always going up. So you have to have a plan.
Even target inflation is 2 to 3%.
Yeah.
So things are never going to get less expensive.
It's kind of like a human body that's like always gaining weight. I mean, eventually, that's if you can picture that. Or I heard the story that a fish will always gain weight.
There's. I don't know if it's like every fish, but like
fish.
A goldfish, it's going to grow to the size of its environment.
So just picture that about inflation. Nothing to mess around with. The last 3, we have medical costs, being too conservative, and the most important thing is not having a plan. There's been many articles about how if you get on the wrong side of your medical bills, those are going to add up. I think that what's coming up on the next article that we saw, if you're too conservative. Right now, it's a saver's market, so you can get 5% bank CDs, you can get 3% money market. But I think that if you're too conservative with actually your retirement funds, then you have to play the interest rate game. You have to start timing interest rates. And we're going to talk about the word on the street is that they might be lowering interest rates a little bit, and that's going to affect the savings rates. But how do you talk to your customers that maybe they were just taught only to invest in CDs? That's all they've ever thought about. And there's no other, they think that there's no other strategy because the stock market's too risky. And how do you talk through your very conservative customers?
So that's a really good question. I do think that is a common mistake that individual investors make, becoming, and I'll state it this way, becoming too conservative too early in their investing journey. And I'll hear sometimes questions from someone who could be 63 years old. Well, don't you think I'm just too old for that type of risk? Now, and I'm not saying that maybe all your money needs to be in the stock market, but if you're 63, the odds of you living to 83 are pretty good as long as you're fairly healthy, at least decently healthy, right? So we can start to make the argument. We have the time horizon to be able to do it. I think the best way to, build confidence in that for people is, one, doing a financial plan and showing them the portfolio that gives you the best probability of a good outcome. And I think just basic things beyond that are even more simple. Over the next 10, 20 years, do you really think companies in America are going to get worse at making money? Well, I don't think so. And what's another reality of the money you have in the market? Is it going to fluctuate more than your CDs and more than your bonds and all that? Yeah, absolutely. I would expect that to happen. But if you can have good investor behavior and not make choices based on emotion and account fluctuation, I think you can stay invested in the equity markets for long periods of time. Now, if you're 85 years old and you come to me and you say, I just want to own CDs, well, you've retired already, you've lived a long time, you're just ready to have no risk at all. Which even at that point, you can't eliminate all risk in your life. So, yeah, I agree. I think becoming too conservative too early is a mistake that investors in general make.
And I see this. I had this happen with a family friend where she received a huge inheritance, and I said, "Well, what's the story behind this money? Where do you want this money to go, or what do you want to have happen with this money?" And she said, "All I want to do is leave it to my kids. I'm not going to touch it at all." And she went out and bought a bank CD, and I recommended something that was more of a balanced situation. And as well as I, as hindsight's 2020, but the stock market's up 50% since January of 2023, and that's when she went out and bought her bank CDs. So even though her kids are going to get something, they would have participated in, like what you said, the growth of the U.S. economy a little bit more.
Well, right, in a situation for inheritance, right? I don't know the ages, but for money you're going to leave for kids, well, now we're talking an investing time horizon that's one, your life, and then whoever inherits it, their life. So how many years?
Right.
You could easily add 20, 30, 40, 50 years to the investment time horizon on money that you're going to leave as far as your legacy
Absolutely.
and inheritance is concerned.
So I think the most, a lot of times if you just want to jump on the most conservative option, but again, back to the never-do list, not having a financial plan. And I read another book that was kind of neat. I think that when we put our plans together, where there's always a margin of safety involved, and we always use a margin of safety that might be an investment, some type of investment product or financial product. This author had 3 different types of margins of safeties that you could use in financial plans. That if you think about it, it boils down to what your identity is with money. And I'm going to name these 3 for you. I think you really like them. If you're doing a financial plan, if you're frugal, you have a loose time horizon. So in other words, you can work whenever you want. You don't necessarily have to retire ever. And you're a flexible thinker, back to not looking beyond CDs. Then that you've actually created a margin of safety, just as kind of like what you mentioned, Elias, the investor behavior. If you have those 3, in addition to having some advice from an advisor and structuring a nice portfolio. But I really like those. Being frugal, having a loose time horizon, and being a flexible thinker is going to help a financial plan too.
Those are all things I share with with most potential new investing clients of the firm. I share one of the things we're looking for are people who are open-minded, right? Because if we take a very our approach is more like a consultation. So if you're closed-minded and you're not open to talking about ideas and potential ways to solve problems and solutions, I'm not really equipped to help you.
What do you do when you have a new prospective clients maybe shopping around, and they've gotten so many recommendations on financial products that all sound so good that they don't really want to do a financial plan at that point. They just want the hammer and the nail, and then just move on down the road. How do you help those customers go back to square one and just do the plan?
That's sometimes hard to do, right? If you're very product focused, our process is very rigid, and I don't, me personally, I wouldn't know how to make a recommendation for someone without the heavy lifting work of the financial plan, right? Because once you get through that exercise, everything else is a lot easier. And if there's good products out there, I don't know. That's a tough one, because if I can't get someone to see the value of it, it's always possible it's not a good fit.
Right.
But I think the majority of people that meet with us, our approach is very good for them and sets them up very nice.
Yeah.
So But in your situation, I've run into that over the years where maybe they're meeting with 2 or 3 places and they're just so confused at this point because they're getting pitched some product over here. We're doing a financial plan over here. I think sometimes being honest with people, I've told people before in meetings, there's no product that's a solution.
Yeah, and I'm kind of dating myself. It reminds me of a Baskin Robbins where it's just like there's 40 different flavors, but you have to do the financial plan to see which one of those flavors is going to fit your family's situation. And we talked on the radio last week about even when you do have a plan, expect the plan not going according to plan. So you have that's where you have an advisor being honest with you and just talking openly, with you, and somebody you can trust, just like an attorney, an accountant, and maybe a family doctor, or a close religious associate, anything like that. That's where we come in.
Yep. So here's a good term for this: expect the plan, or expect the unexpected, basically. And I think, have you heard this yet? The vibecession.
I heard a little bit about it.
Okay.
But,
so I'll kind of define this for the listeners. This new term going around in finance, it's vibecession. So it's kind of a mix of vibe and recession.
Is that like a disco club or something?
It should be. We should open a disco club and call it the vibecession.
You put my dancing boots on. And
yeah, so there's really this recession that we're going through. It's kind of confusing in a lot of ways, right? Because we started a recession and then our government told us, well, it's not technically a recession. Well, maybe by definition it's a recession, but here's these other reasons why it's not a recession. And now consumers are almost split, where there are people that they feel good about their personal situation, but they don't feel good about the overall economy. There are people who feel poorly about their personal situation, but they feel good about the overall economy. And as I was thinking about this and this term and how it's being used, it's very fitting for the situation we're in, because depending on who you listen to, which almost every economist I've been following and listening to is talking about how strong this economy remains, even with this restrictive monetary policy and rising interest rates. But then we've heard of massive layoffs, right? Which I think we've talked about this, how I think some of this recession it's kind of like a rolling recession going through different regions at different times. It didn't really impact the whole country all at the same time. And then you'll hear about a layoff, but then we still have all these companies in the S&P 500, their earnings come out and, well, look at that. They're making more money than they made last year. They're more profitable now. Their margins are whatever it is, right? So there's all this, it's almost like there's all this conflicting information, and it's really almost a time, I don't know that our overall financial markets and our economy has been through a time exactly like this. Going from free money to aggressively raising rates, have a market recover as fast as it has. And then not only we had a nice recovery, but the outlook is pretty good on all of these companies. So it's almost, I think there's kind of this, people are feeling good, but then there's kind of what's lurking around the corner, right? So I think that's what this vibecession, I like that term. I want to start using it more. So the term vibecession, it really resonated with me. And Jonas, do you have any thoughts on just consumer concerns about inflation and Americans kind of struggling to shake off this recessionary environment?
Well, I do, and I really like that too. It's whatever your vibe is. I think that's just a confidence level as an American. And, we're coming up on this election, and they're always going to say, are you better off than you were 3 years ago? Vote for me. That's what the politicians do. And that's a vibe. And I think that what's happening is I'm glad they came up with this term because it reminds me of what we do. People come in, Elias, on a different vibe all the time. And the irony is it's different from the facts. We could have all the facts on a robust economy, but I used to have this chart doing workshops where this is back when people only got their statements 4 times a year. So there was a little bit of delay in investors getting their account statements. But we would always ask them the first quarter of the year, what did the stock market do last year? And 85% of them said it went down. Had to have gone down because we had the unrest in the Middle East. We had high inflation. We had all these things, and then we'd unveil this number on the workshop, and the market was plus last year, but all the headlines were bad. But the market was plus. And you mentioned the layoffs. How ironic is it as an investor that you could have your retirement account go up and you could be fired in the same year from a major corporation, from a corporation that actually did a mass layoff, but that looks, that looks really good for their bottom line, their stock price. So you could literally have that happen to you 5 or 6 times. The younger generation could have that happen, maybe once or twice for somebody in their 50s and 60s. But you could literally get laid off, but have your retirement account go up because that company or those Fortune 500 companies laid everybody up, but their stock price looks better when they do that.
It reminds me of one of the first lessons I feel I learned as a college student in either some business class or finance class, that management works on behalf of the shareholders, right? That would explain that, because if a company is internally forecasting slowing of sales, well, how do they show earnings? How do they cut costs, right? And these companies, especially nowadays, they are so good at continuing to be profitable. And I'm sure even the layoffs we're hearing about, they'll be bringing people back. I guess I shouldn't say that because I don't know for sure. My optimistic outlook would be people will get these jobs back and we will be back to work. The other thought that came to me as far as the vibe session, I think it's a great lesson for younger listeners that are listening to the program. Ask yourself who has done well in this economy and during these recessionary times and high inflation. People that owned physical assets like real estate, people that had money in the capital markets, whether it's the stock market or the bond market, fixed income markets, right? So I think it really does highlight the advantages of being someone who is an investor and owns different assets, right? If you can, and that, to me, the kind of always the trifecta is the business owner, they own a little bit of real estate, they have a good capital market portfolio, right? Because then at that point, you're diversified and you're participating in these different asset classes. So I think, and I wouldn't want to hear, and it wouldn't surprise me if you're a young person, you got laid off and you're thinking, how is it possible I lose my job and the stock price goes up? I think the way to think of it is, how do I figure out how to participate in this?
Right.
Because the reality for most people, you're going to get laid off more than once in your life. I mean, if you could, it'd be great if you didn't, right? Let's say you started working at 22 years old and somehow you started at the bottom of a recession or whatever, and the economy just was great for your entire career. That's what we all want, but that's not the reality of how it happens.
Yeah, I think you brought up a really good point there that the younger you are, just visualize yourself exactly what you said, Elias. Do I want to be an owner or do I want to be a loner? And what that means is,
what does that mean? I need to know.
Do I want to own great, haystacks and haystacks of great companies? Do I believe in the progress of the United States? I mean, our standard of living has gone up 20 times over 170 years. Do I do I believe in any of that, or do I just not trust that at all? Do I just think that things are going to go to pot, or am I just a little bit optimistic about our country? America's too great for small dreams. That's what Ronald Reagan said. So if you visualize being an owner, then you want to you don't want to rent. You want to be in a house. You want to own baskets of really good companies. Loaners, that's an option for maybe retirement. A loaner would buy bonds, right? And Warren Buffett in his book, he made it look really simple. So he basically he stopped loaning money to companies as a bond, even though he was making 8%. Guess what? The number one reason why he stopped clipping coupons and loaning money to companies for formats kind of like a bond. Guess why he got tired of making 8% on a pretty steady basis?
Warren Buffett?
Yeah.
Well, I guess to me, he realized he could buy more shares of their company, make more money or something.
Yeah, and it was boring and it was too time consuming.
Yeah, there you go. Those two reasons, boring and time consuming.
So that's what loaners do. So it's something that kind of have helped some of my customers look at yourself as an investor, being an owner and not necessarily a loaner. The younger you are.
Yeah, and here's a common question we get, and we'll transition into some listener questions. So here's the first one, and there's a chart that coincides with this one that I think we'll probably make available. Is it smart to buy stocks when they're at record highs? And that's where we're at right now. The overall market is trading around all-time record highs. So we found this really good chart, and Nationwide sent this out. And I think it's very common when stocks go on a good run, investors start to wonder, am I going to get rug pulled, right? If I put money in, and everyone thinks that way, right? Oh, I got 200,000 sitting here. As soon as I put it in, I know the market's going down. Well, if you start to look at forward performance, which means we're at all-time highs, and then what happens the next 12 months, and then the chart has what happens for returns in the next 12 months, and then returns in the next 3-year periods. And it's a 1980 to present performance measured day by day. So 75% of the time, 12 months later, even from highs in the market, accounts are up. So 75% of the time you win. In the next 3-year period, it's 93% of the time. And I think it goes back to a common question: when is a good time to buy? Well, yesterday was a great time to buy. Today's a great time to buy. Now, you got to keep in mind, what's your time horizon? What is your risk tolerance? And all of these things. But I think the question of, is it smart to buy stocks when they're at record highs? I would answer that by saying maybe it's not ideal. I like buying more when the market's down 35%. We all do.
Right.
But that doesn't mean it's a bad time to buy just because we're trading at record highs, and I think the data supports that. Any thoughts on that?
Well, we always say on the radio, what's easier to do, buy low or sell high, and I think that you're exactly onto something. Depending on your time horizon, the way we do it with haystacks, and I read an article about an art dealer that passed away, and he donated close to $1 billion to I think it was the German, the country of Germany, where he was from. And they asked his family how he did it, and he had Rembrandts and Picassos and everything else. For every one Rembrandt that was worth like $20 million, Elias, he had like 1,000 other paintings that were worthless. So he basically he did his own indexing. He was just a collector.
He bought the art no matter what.
He bought the art.
Because he knew he couldn't predict the future.
He couldn't predict the future, so he was just always buying, and he was buying haystacks. and somewhere in those haystacks, it was valuable because he owned the whole haystack. So not all of the companies are going to be profitable over time, but like you said, a lot of them companies are in the business of making money, and Americans are in the business of spending money. It's a good combination.
Yep. Yeah. Do you want to do your listener question from Matt, and then we could probably wrap up?
Yeah. Do you want to read that listener question real fast?
Yep. So this listener question from Matt: I am 52 years old. My wife died unexpectedly last year. Our financial plan was designed around both of us having Social Security and continuing to save in our 401k plans. What things should I be thinking about, or what changes should I be making to my financial plan now that it is just me?
Yeah, really sorry for your loss, Matt. This is a great time to really review your situation right now. This is a great time to do a plan. I mean, you have to assess your emergency fund. You probably want to seek some professional advice unless you want to settle your wife's financial affairs, and you have to find out what your survivor benefits are. This is where I think unfortunately, the bad part about our business, Elias, is we always have to settle estates each year. This is where a really good professional financial office can come in and help.
Yeah, that's very true, and it's a difficult part of the business when people lose loved ones, but it is part of it nonetheless. And I think it's really when this happens, you just have to start with reevaluate the situation, right? Let's reevaluate the situation, and now we need a new plan. Like, we just need to make, maybe not a new plan, but we probably need to make some adjustments to hit the goals, right? And hopefully, if you were working with someone, I would like to point out, because this was someone who's 52,
right?
And I think, if you're married and you have a family, there's a risk management tool out there called life insurance that you should really look at owning and having, because what is that going to do for you in this situation? It can help complete the financial plan, right? So there's all these different moving parts and things that need to be considered. Do you have anything else on that?
Yeah, just the emotional considerations. You're almost in a holding pattern when you're trying to settle estates and figure out all this financial stuff. If you have an office do it for you, or actually help you with most of it, then you can grieve. And I think that's important, because if I have any legal work done, the last thing I'm going to do is do it myself. And this is an opportunity for people just to delegate the financial stuff and make sure that everything gets re-registered right and settled correctly.
Well, Jonas, thank you for filling in today and being on the show. For the listeners. If you'd like any help with anything, if you'd like to set up an initial consultation, you can reach us at btwellshow.com and all of the social media platforms. Thank you for listening.